For a brief moment, global currency markets behaved in a way they almost never do. There was no panic, no headline shock, no emergency announcement, and yet, positioning across nearly every major currency pair broke down at the same time. Traders noticed it first in the derivatives markets, then in funding spreads, then in volatility surfaces that began to lift in unison, not violently but decisively. The kind of move that doesn't scream crisis, but whispers transition. Within 72 hours, the Japanese yen stopped behaving like a funding currency. And when that happens, the global financial system doesn't adjust. It recalibrates. This wasn't a reaction to inflation data. It wasn't about the Federal Reserve. It wasn't even, at first glance, about Japan. It was about leverage that had accumulated quietly for years. And the moment that leverage realized it was no longer safe. To understand why this mattered, you have to forget how most people think about currencies. Exchange rates are not prices in the traditional sense. They are balances of pressure. They reflect not just trade flows or interest rate differentials, but expectations embedded in trillions of dollars of leverage, derivatives, and funding structures that operate largely outside public view. For more than a decade, the yen had occupied a very specific role in that system. It was not a currency people wanted to own. It was a currency people wanted to borrow. Cheap, stable, predictable. A tool, not a destination. That role shaped global markets in ways most investors never had to think about. Hedge funds, banks, asset managers, corporations, all built structures assuming the yen would remain weak, liquid, and available. It became the base layer of global leverage. And then, quietly, that assumption stopped being true. Japan did not announce a regime change. There was no declaration of a new policy era. What happened was more subtle, and therefore more powerful. A series of small decisions, technical adjustments, and communication choices signaled something institutional investors understand immediately. The risk profile of the yen was changing, not dramatically, not violently, but structurally. For months, the Japanese currency had been weakening. On the surface, it looked like policy divergence, Japan holding rates near zero while the rest of the developed world tightened aggressively. Commentators framed it as passivity, even failure. A country unable or unwilling to defend its currency. But currencies rarely move that far. That consistently, without intent. As the yen slid to levels unseen in decades, something else was happening beneath the surface. Carry trade exposure ballooned, funding structures expanded, short yen positions became consensus. What had once been a trade became infrastructure. By mid-year, the global system was leaning heavily in one direction. Borrow yen, sell yen, fund everything else. That is not a stable configuration. In markets, the most dangerous moments are not when people disagree. They are when everyone agrees. When positioning becomes crowded, fragility increases. A system can look calm right up until the moment it isn't. Japan understood this dynamic better than almost anyone. They've lived through asset bubbles, deflationary spirals, currency crises, and decades of unconventional policy. They know that control doesn't come from brute force. It comes from timing. When the intervention finally came, it wasn't framed as intervention. There was no spectacle. But the scale and sequencing mattered more than the headline number. Buying pressure appeared precisely where speculative positioning was most vulnerable. Liquidity thinned. Stops triggered. Algorithms responded. What looked like a modest policy action cascaded through layers of leverage that had never been stress-tested under those conditions. As traders scrambled to unwind positions, they did the only thing they could do. Buy yen. That feedback loop is brutal. When a funding currency strengthens, it forces deleveraging. Deleveraging forces more buying. More buying accelerates the move. The system feeds on itself. Within days, the yen had repriced not because Japan won a currency battle, but because the structure of global leverage had been exposed. This is the part most commentary missed. The move wasn't about defending a level. It was about redefining behavior. Once a funding currency becomes volatile, it stops being useful as funding. Once it stops being useful, the trades built on top of it collapse under their own weight. And those trades were everywhere. Emerging markets felt it first. Capital that had flowed easily into higher-yielding currencies began to reverse. Volatility rose not because fundamentals changed overnight, but because the cost of leverage did. Equities reacted next. particularly growth sectors that had benefited from cheap global funding. Valuations that assumed low discount rates began to compress. Credit markets followed, spreads widened, refinancing assumptions shifted. Suddenly, debt structures that looked sustainable under one currency regime looked fragile under another. This is how systemic repricing actually happens. Not through crashes, but through constraints. Japan's move forced the market to confront a simple reality. The era of frictionless yen funding was over. That realization changed how risk was priced everywhere. What made this moment especially important was not just the magnitude of the move, but the message it sent. Japan demonstrated that in an age of algorithmic trading, massive liquidity, and globalized leverage, power does not come from scale alone. It comes from understanding positioning. This is a different model of central banking. Less about setting rates, more about managing incentives. Rather than fighting speculators head-on, Japan let them build the structure themselves, and then removed a single assumption that structure depended on. The result was not chaos, but control. Other central banks noticed. For years, currency intervention had been seen as ineffective, even outdated. Markets were too big, capital too mobile. Japan showed that this thinking was incomplete. Markets may be large, but positioning is finite. Liquidity may be deep, but leverage concentrates. By targeting that concentration, a central bank can achieve disproportionate impact. This has implications far beyond Japan. If funding currencies are no longer stable, global leverage becomes more expensive. If leverage becomes more expensive, asset prices must adjust. Not all at once, not violently, but persistently. That's how cycles turn. For investors, this moment matters because it marks a shift in regime. The assumptions that govern the post-2008 world, abundant liquidity, predictable funding, suppressed volatility, are no longer guaranteed. This doesn't mean crisis is inevitable. It means selectivity returns. Carry trades become tactical rather than structural. Currency risk re-enters portfolio construction. Hedging costs rise. Capital becomes more discerning. In that environment, some assets suffer not because they are weak, but because they were priced for a world that no longer exists. Others benefit not because they are exciting, but because they are resilient. Japan's currency repricing was not a headline event. It was a system signal. It told the market that central banks are no longer just referees. They are players who understand the game at a granular level. It told speculators that consensus is dangerous. And it told long-term investors that the cost of ignoring currency structure just went up. The most important part is this. The move is not over. Once a funding regime breaks, the adjustment unfolds over months and years, not days. Portfolios rebalance, risk models update, new equilibria form. Some of the effects will be subtle, others will be obvious only in hindsight, but the direction is clear. Global markets are entering a phase where leverage is more expensive, volatility is more honest, and policy is more strategic. Japan didn't cause that shift alone, but it exposed it. And once exposed, systems don't go back to pretending. They adapt.